3 weeks ago, Goldman Sachs filed a routine disclosure that should have stopped every financial network in its tracks. It didn't. Buried in an SEC filing released late Friday afternoon, one of the most powerful banks in history revealed something extraordinary. They had quietly dumped hundreds of billions of dollars in United States Treasury bonds in just a few months. This wasn't portfolio adjustment. This was systematic evacuation from what textbooks call the safest asset on earth. And they're not alone. Over $847 billion in Treasury bonds sold by major financial institutions in the past year and a half. To put that in perspective, that's more than Switzerland's entire gross domestic product. That's 3 times the annual United States military budget. The smartest money in the world just walked away from government debt, while you're being told the economy is fine and inflation is under control. So here's the question. Nobody in mainstream finance is asking, what do they see that you don't? I'm Marcus Caldwell, and I've spent the last 18 months tracking institutional bond movements that the mainstream media refuses to cover. What I'm about to show you isn't speculation. It's documented fact filed with the Securities and Exchange Commission. Let me show you how Treasury bonds actually work, because understanding this mechanism is critical to seeing why massive selling is a 5-alarm fire. When you buy a Treasury bond, you're lending money to the United States government. They promise to repay you with interest over different time periods: 3 months, 1 year, 5 years, 10 years, 30 years. Here's the part most people miss. Bond prices and interest rates move in opposite directions. Always. This is mathematical law, not theory. If you bought a 10-year Treasury in 2020, paying 2% interest for $1,000, and then rates jump to 4.5%, your bond is suddenly worth much less. Why would anyone pay you $1,000 for a 2% bond when they can buy a brand new 4.5% bond for the same price? They wouldn't. So if you need to sell, you take a massive loss. Maybe $750. Maybe $700. This is what killed Silicon Valley Bank in March 2023. They held billions in Treasury bonds bought when rates were near zero. When rates spiked, those bonds crashed in value. When depositors panicked and withdrew money, the bank had to sell bonds at devastating losses. The bank failed in 48 hours. That triggered Signature Bank, First Republic, and forced the Federal Reserve into emergency lending programs to prevent total systemic collapse. And that was just one mid-sized bank. Now imagine the largest banks in the world selling trillions in bonds because they see something worse coming. That's exactly where we are. Before I reveal what Goldman's balance sheet is actually telling us, if this intelligence is valuable to you, hit that subscribe button and turn on notifications. This channel exists to give you the market insights institutions don't want retail investors to have. Your subscription directly supports independent financial analysis, free from Wall Street's spin. Now let's examine what the smart money is doing right now. Goldman Sachs' third quarter 2025 filing showed their United States government securities holdings decreased by 42% compared to the prior year. 42%. We're talking about a reduction from approximately $280 billion down to roughly $160 billion. That's $120 billion in bonds sold in months, and that's just Goldman. J.P. Morgan Chase reduced their available-for-sale securities portfolio by 15% in Q3 2024 alone. Bank of America dumped $37 billion in the second half of 2024. Citigroup cut $23 billion. Wells Fargo, Morgan Stanley, all selling. When you total it across major banks, we're looking at over $300 billion in Treasury sales from the largest institutions in 18 months. Regional banks sold another $290 billion. The total exceeds $800 billion. Now the banks will tell you this is about regulatory requirements, Basel III capital ratios, balance sheet optimization. Those explanations sound reasonable until you realize one critical fact. They're taking voluntary losses right now. They're recognizing billions in losses they could avoid by simply holding bonds to maturity. Why would they voluntarily take massive hits unless they believe something much worse is coming? Look at what else Goldman has done in the past 18 months. They increased cash reserves by 38%. They reduced commercial real estate exposure by 29%. They cut leveraged lending. They tightened credit standards for corporate clients. Every single move points in the same direction. Defense. This is not how banks behave in a healthy economy. In a healthy economy, banks lend aggressively, maximize leverage, chase returns. Goldman Sachs is doing the opposite. They're hoarding cash, cutting risk, and selling what's supposed to be the safest asset in the world. And they're not stupid. Goldman has survived every financial crisis in modern history. The dot-com crash, the mortgage crisis, the European debt crisis, COVID. They didn't survive by being lucky. They survived by seeing problems before everyone else and positioning accordingly. When Goldman Sachs sells $847 billion in government bonds, they're not guessing. They're reading data you don't have access to. They're running models you can't see. And those models are screaming that United States Treasury bonds are a bad bet right now. To understand why this matters, we need to talk about the trap the United States government is in. As of February 2026, the Federal Reserve's benchmark interest rate sits at 4.25 to 4.5%. Here's the problem. The United States government currently has $36.2 trillion in debt. $36.2 trillion. That debt is not free. The government has to pay interest on it. And when interest rates go up, the cost of that debt explodes. In fiscal year 2023, the United States paid $659 billion just in interest payments on the national debt. In fiscal year 2024, interest payments jumped to $879 billion. That's a 33% increase in 1 year. Now we're in 2026, and the latest Congressional Budget Office projections estimate that interest payments for this fiscal year will exceed $1.1 trillion. $1 trillion. Not going to schools, not going to infrastructure, not going to defense. Just interest. Just the cost of servicing previous debt. To put that in perspective, $1 trillion in annual interest is more than the United States spends on Medicaid. It's more than the entire defense budget minus war funding. It's approaching the size of Social Security payments. The United States government is spending more on interest than on almost any actual government program. And here's where the trap closes. That $1 trillion in interest has to be paid. The government doesn't have $1 trillion in surplus revenue. So how do they pay it? They borrow more money. They issue more bonds, which increases the total debt, which means next year the interest payment is even higher, which means they have to borrow even more. This is called a debt spiral. And the only ways to escape it are to drastically cut spending, which is politically impossible, or raise taxes, which is economically destructive, or grow the economy faster than debt, which isn't happening, or print money, which causes inflation or default. Those are the options, and none of them are good. Now let's add another layer. A huge chunk of United States debt, roughly $7.6 trillion, is owned by foreign countries. The biggest holders are Japan with $1.08 trillion and China with $760 billion. These countries buy United States bonds because they need a safe place to park their trade surplus dollars. But something changed in 2022. Foreign buyers started selling. China has reduced its Treasury holdings from over $1 trillion in 2013 to $760 billion today. That's a 24% reduction. Japan reduced holdings by $63 billion in 2024 alone. When foreign central banks sell United States bonds, someone else has to buy them. And increasingly, the buyer is the United States government itself. The Federal Reserve, the Treasury Department, and domestic institutions are absorbing debt that foreign buyers don't want. This creates a doom loop. The government borrows money. Foreign buyers don't want it. Domestic buyers like banks are selling it. So the Federal Reserve has to step in and buy it with newly created money. That increases the money supply. That causes inflation. That forces the Federal Reserve to raise interest rates to fight inflation. Higher rates make the debt more expensive, which requires more borrowing, which requires more money creation, which causes more inflation. You see the trap? It's mathematical, it's unavoidable, and Goldman Sachs sees it. Let me take you back to a moment in history that rhymes with today. 1979. The United States is in trouble. Inflation is running at 13% annually. The economy is stagnant. Unemployment is rising. Confidence in the dollar is collapsing. Into this crisis steps Paul Volcker. He becomes chairman of the Federal Reserve in August 1979, and he makes a decision that changes everything. He raises interest rates to 20%. 20%. Raising rates to 20% does stop inflation, but it also triggers the worst recession since the Great Depression. Unemployment hits 10.8%. Thousands of businesses fail. The pain is immense, but here's the key detail. In 1979, when Volcker started raising rates, the United States national debt was $845 billion total, and the debt to GDP ratio was around 32%. Today, the national debt is $36.2 trillion. The debt to GDP ratio is 124%. The debt is 43 times larger in absolute terms and 4 times larger relative to the size of the economy. Do you understand what that means? Paul Volcker could raise rates to 20% because the debt was manageable. The interest payments, even at 20%, wouldn't bankrupt the government. Today, if the Federal Reserve tried to raise rates to 20% to fight inflation, the interest on $36 trillion would be $7 trillion per year. That's more than the entire federal budget. The government could not survive. They would have to default or print money so aggressively that the dollar would collapse. The Volcker option doesn't exist anymore. The debt is too large, so the Federal Reserve is stuck. If inflation rises again, they can't raise rates high enough to stop it without destroying the government's ability to pay its debts. And if they keep rates low to protect the government, inflation spirals out of control and destroys the currency anyway. This is the trap Goldman Sachs sees. This is why they're selling bonds. Because in a debt trap, bonds are the worst place to be. If the government prints money to avoid default, inflation destroys the value of bonds. If the government tries to raise rates to fight inflation, the economy collapses and the government defaults on bonds. Either way, bondholders lose. Let me bring this down from macro theory to your actual life. Because when the bond market breaks, it doesn't just affect banks and governments. It affects you directly. First, mortgage rates. Mortgage rates are tied to Treasury yields. When Treasury yields rise, mortgage rates rise. Right now, the average 30-year fixed mortgage rate is around 6.8%. That's already high by historical standards. But if Treasury yields spike in a crisis, mortgage rates could hit 9, 10, 12%. At 12%, the monthly payment on a $300,000 mortgage is $3,086. At current rates of 6.8%, it's $1,960. That's an $1,100 per month increase. Most people can't afford that. Home sales would collapse. Prices would fall. Homeowners who bought at the peak would be underwater, owing more than the house is worth. Second, your retirement accounts. If you have a 401k or an IRA, there's a very good chance a significant portion is in bond funds. Bonds are supposed to be the safe part of your portfolio, but when bond prices fall, those funds lose value. In 2022, when the Federal Reserve started raising rates, the Bloomberg Aggregate Bond Index fell 13%. That was the worst year for bonds in decades, and rates only went from 0 to 5%. Imagine what happens if rates go from 5% to 10%. Bond funds could lose 30, 40, 50% of their value. Your safe money gone. Third, your job. When interest rates spike, businesses that rely on borrowing get crushed. Commercial real estate, which is already in crisis with empty office buildings, would collapse completely. Construction would stop. Manufacturing would contract. Retail would see mass closures. Unemployment would spike, not gradually, fast. In the 2008 financial crisis, unemployment went from 4.7% to 10% in less than 2 years. And that crisis started in housing. A Treasury crisis would be bigger. Fourth, inflation. If the government chooses to print money rather than default, you get inflation. And not the 3% inflation we complain about now, real inflation. 10, 20, 30% or more. Your paycheck stays the same, but groceries cost twice as much. Gas costs twice as much. Rent doubles. You effectively become poorer overnight without losing your job. This is not hypothetical. This happened in the United States in the 1970s. It happened in Argentina multiple times. It's happening in Venezuela right now. When governments print money to pay debts, the people holding that currency pay the price. So why is this happening now? What changed in 2025 and early 2026 that triggered this massive bond exodus? Several things came together at once. First, the Federal Reserve's balance sheet reduction. During COVID, the Fed bought over $4 trillion in Treasury bonds. They ballooned their balance sheet from $4 trillion to $9 trillion. Then, starting in mid-2022, they began quantitative tightening. As of February 2026, the Fed's balance sheet is down to $7.1 trillion. They've reduced by $1.9 trillion. That's $1.9 trillion in bonds that the private market had to absorb. The private market, as we've seen, doesn't want them. Banks are selling, not buying. Second, the deficit exploded again. The government is borrowing $2 trillion in a single year. That's $2 trillion in new bonds that need buyers. And the buyers are disappearing. Third, geopolitical instability. Wars in Ukraine and Gaza have created uncertainty. China and the United States are in an economic cold war with tariffs and sanctions. Trade is fragmenting. Countries are looking for alternatives to the dollar system. The BRICS nations are developing payment systems that bypass United States banks. The dollar's dominance, which is the only reason anyone wants Treasury bonds in the first place, is B.